What is SPV? What is loan to valuation? What is all this jargon that people use in the mortgage industry? I remember one time someone just asked me a simple question, and this was an adult. They asked me, "What is a mortgage?" And I said, "A mortgage is a really big loan." Today, I'm going to explain some of the different terminology that people use in the mortgage industry. This is ideal for anyone. Even people that have mortgages quite often don't understand what a mortgage is, what the criteria is, etc. So I'm going to go through all of that today. My name is Anthony Lindsay, and I've been in finance for over 30 years. I always say that because when you hear from me, you're not just hearing from someone who does lending. I've done wealth management. I've also done collection. So I have a wealth of information. I make these videos to share my 30 years experience with you. But also, these videos are not designed to replace you speaking to a qualified professional who understands your needs and who understands what your appetite for risk is, etc. And always with mortgages, don't forget that your property could be repossessed if you don't keep up the repayments on your mortgage. So, what is a mortgage? A mortgage is a really big loan, and it might sound simple. But for many people in the UK, even people with mortgages, they don't fully understand the terminology. And quite often, you will find that brokers use terminology and they'll do all the work for you, and you don't always get everything explained. So remember this, it's not rocket science, it's not a dark art. It's going to come down to three key things, which I will explain now: your credit, your income, and your deposit. So let's just go through my top tips when getting a mortgage. Some of them you like, some of them you might not like, and some of them you've probably heard before. So tip number one, don't obsess about rates. Don't obsess about rates. What do I mean by that? Well, quite often clients will approach me and say, "Well, I saw that the Bank of England raised its rate or lowered its rate or kept the rate the same." The Bank of England base rates, although they do guide what the mortgage industry is going to do, there's not always a direct correlation in real time. So I always talk to my clients, understand what their budget is, what their needs are, and I talk to them about an affordable monthly repayment. As someone that worked in collections for over a decade and also worked in pre litigation where we were dealing with foreclosures, what I found is quite often people either don't listen to the information that the broker is giving them, or they purchase a property above what they can afford, assuming that everything will always go right. And things can go wrong. So we want to make sure that you find a mortgage that is affordable to you, you have the right protections in place. Rates go up and rates go down. As I'm recording this video, you have a lot of people that are going to be coming off really low rates that were fixed during the time of the 2008 recession. So you have people coming off that. You have people coming off low rates during the COVID period. So rates are going to go up. So anything in today's market is going to seem super high to them. But I'd say find a comfortable monthly repayment. The other thing that I would say when you're considering a mortgage is understand the terms in practice. So understand the overall term in practice. So there's two key numbers or two key time periods that you're going to be looking at when you get a mortgage. The overall term, which is usually the longer number, it could be 10, 15, 25, 35, 40 years, whatever. And the fixed period if you decide to do a fixed period. The overall term length, and let's just talk about residential mortgages now. The overall term is the long number. But you don't really need to fixate on that either, because the overall term, when you go to remortgage, you can adjust that. So if you've done a 5-year fix, let's just say for an easy example, you do a 20-year term, but you do a 5-year fixed. After that 5 years, in theory, you have 15 years left on your term. But when you remortgage, you could remortgage and change that term. So don't obsess on the terms, don't obsess on the rates. Be realistic and buy within your budget. So be realistic. If you're on £50,000 a year and you don't have tons of money or a rich aunt or uncle, you're not going to be able to buy £1 million house. So be realistic. If you're younger, keep in mind this may not be your forever home. Your parents and your grandparents, in most cases, the first home that they purchased was not the home that you're going to inherit. They usually purchased something that was affordable and then moved up the property ladder. The three key things that you're going to need to understand when getting a mortgage, I call it SID, and that's also the title of my next book: credit, income, and deposit. If you can understand these three things and how they impact the type of mortgage you get, you're well on your way to understanding mortgages. So, your credit. Get your credit report at least once a year. At least once a year. I would say twice a year, but check your credit report from checkmyfile.com. Checkmyfile.com. Satisfy any unsettled issues, stop applying for new credit, and pay anything in dispute. That's probably not what people online tell you. People will tell you, oh, there's these programs where you can get debt written off. If that's the right thing for you, by all means, do it. But sometimes I come across clients who have a small amount with, BT or a mobile phone company. It just is £200-300. And morally and practically speaking, the client is probably 100% correct. But what their credit report is saying is something different. Remember, the lender is going to go by what it says on your credit report. You can dispute these things, and if you're in the right, potentially you can get it updated. But if you're in the middle of a mortgage or you've waited too long to speak to a mortgage broker and get that item resolved, quite often it makes more sense to just pay the debt and then dispute. Because whilst that debt is on your credit report or the default or anything adverse, it's going to impact the type of lenders you can go to, and therefore it will impact the rate. So think about your credit, check your credit report at least once a year. I would say every 6 months, and make sure you pull your credit report before you start the mortgage process. That way, anything that you need to resolve, you can resolve it well in advance of applying for the mortgage, and that will allow you to get the best rate. The other thing to consider is your income. How are you going to pay a mortgage back if you don't have an income? So you have credit, now you have income. Know your employment status and your salary. Are you on probation? Are you paid via an umbrella company? What does HMRC say? And your second income. So let's just start with knowing your employment status. Are you full-time employed? Meaning, do you have a fixed contract that has a stated annual salary? This is important because, as a rule of thumb, if you watch my videos, you know I use an income multiplier of 4 times your salary. And that's your base salary. So once you get into the weeds of your mortgage, we may find that you qualify for a higher multiple. There are some lenders that will do 7 times your income, but this is going to be determined by the type of job you have. It will also be determined by the fact, is it a permanent role? Is it a part-time role? Is it a 0 hours contract? So going into the mortgage, understand what type of contract you have, and if your contract has a fixed amount, meaning if you take a few days off sick, at the end of the month, you still get the same salary. The other thing, are you on probation, or are you paid through an umbrella company? Some lenders, if you are currently on probation, meaning you've started a new job, they won't lend. They'll wait and need 3 months pay slips after you're on probation. So that might mean 6 months. Other lenders will lend just with an offer letter. Some of the provisions would have to be a national company, so like the NHS or a bank, etc. So it can't be cousin Bob's burger joint. All right. So some lenders will lend based on that. And there's variations all the way across from, you have to be off probation to just a letter. So make sure that your employment status is sound. Also, are you self-employed, and are you potentially paid through an umbrella company? Some lenders won't lend if you are paid through an umbrella company. Not that there's anything wrong with that, but again, it's going to limit your choices. So you want to understand that going into getting a mortgage. Your circumstance is your circumstance, so you're not going to be able to change that. But when you explain it to a mortgage broker, if it's an experienced mortgage broker like myself, we can find a lender that will work with you. We'll probably go with a specialist lender, and that's fine because that will get you where you need to be. Also, if it isn't documented, it didn't happen. So, one of the things that I do find quite often is that people say, yeah, well, I have this side hustle and I make this additional money. If you're not reporting it to the HMRC and you're not paying taxes on it, then you can't include it in your affordability. So always make sure any money you're making and anything that you're doing is well within the law. Don't do things to avoid things because it's not right. You will get caught and it will end up costing you more money in the long run. So we've gone through credit, we've gone through income. Now we're going to talk about deposit. So ask yourself, the money that you're using towards the purchase of your property, does it make sense? If you work at McDonald's and you have £3,000 going into your bank account from some random source every month, that doesn't make sense. Where does it come from? Can it be traced? It needs to be able to be traced. Lenders need to know where the money came from. So the cleanest and best thing that they can see is that you get paid into your ABC account, your current account through your salary. You then transfer money into a savings account, hopefully a high interest savings account. And they can track that. They can see your salary come in. They'll have your pay slips. They'll then be able to see that savings. And just a word of advice with that, quite often, current accounts, your standard current account, isn't going to give you as high an interest rate as some other accounts that you may be able to find on Money Savings Expert. I'm not giving tax advice, not giving legal advice or financial advice. Just as someone who's worked in the industry for a long time, I would recommend that anyone that is saving in their current account, shop around and find the very best savings rate for you and your circumstances. The other thing about savings is there are right to buy, gifted equity, and concessionary mortgages. So that means you may not need to come out of your pocket with a full deposit. Sometimes you can have gifted equity. I have a video about that, and concessionary mortgages. But if you're getting a gifted deposit, so if a family member is giving you, not lending you, money towards your deposit, you're going to need to let the mortgage broker know that in advance. That person will need to sign a gift letter and make sure that it is a gift and not a loan, because if it's a loan, then you're going to have to pay it back. That's going to come out of your affordability when they assess your affordability for the mortgage. Banks aren't here to trip you up. They want to lend money, but they must do it compliantly. And a mortgage broker is going to make sure that everything that you're doing is compliant and adheres to the FCA guidelines and policies, and that they do their due diligence and duty of care to take care of you as a client and make sure that you end up in a good position, understanding exactly what you're doing. The other thing to keep in mind, we are doing our 6th annual East London Property Expo, March 21st in London. If you want to meet lenders and mortgage brokers, hear and ask questions, learn from others, and network, the East London Property Expo is for you. At the expo, we will have masterclasses, breakout sessions. We'll also have free seminars. One of the fantastic things about the expo is you will be able to hear from solicitors, you'll hear from accountants, you'll hear from property investors, and you can take all of that information and then go to a professional that you know and trust and ask questions. They'll be able to give you the best advice that's suited for your needs. So that's the East London Property Expo, March 21st in London, 2026. Make sure you scan the QR code. But let's go back to something that trips people up regularly. What the industry refers to as a vanilla customer. So often when you see advertisements on television, they will most likely be talking around the concept of what we call a vanilla client. So a vanilla client is someone who has a UK passport, no credit issues ever, full-time employed, PAYE, good deposit, and purchasing at a low multiple of their income. That's not to say that these are the only type of people that banks will lend to. But these are the clients that have all the choices because they have a UK passport, because they don't have any credit issues, they have a good deposit, and their income is traceable, it's easy, they're not on probation, they are salaried permanent contract workers. If you fall outside of that, don't worry because we do have specialist lenders that can help you. But do keep in mind if you don't meet all of this criteria, you may not qualify for the deals that you think you do. Frequently, I have clients come to me who may have had a hiccup with their credit or some other circumstances. They're buying well above the standard multiples for their mortgage. I'll find them the perfect product for them based on their circumstances and based on their budget. And they're like, well, my friend Joe or my barber told me I can get a better rate with this bank. Never compare your circumstances to somebody else's because your circumstances and your purchase process is going to be unique to you. A mortgage broker is going to find the best product for you. So don't compare what your mortgage broker gets you to the family across the street. If you fall outside of that vanilla client, or if you've had credit issues, or if there's anything that's going to mean that the main lenders aren't able to offer you something at the moment, you may need to go to a specialist lender. Don't be embarrassed. Don't be ashamed. Specialist lenders are great financial institutions that are there to help you get on the property ladder or help you get the mortgage you need. And you don't have to stay with them. Once you've tidied things up or once the default that you had that was preventing you from going to a high street lender, once you put some distance between that and where you are now, when you remortgage, you can always go to one of those high street lenders. So, what is a specialist lender? Specialist mortgage lender is a financial institution that provides mortgages to individuals whose circumstances don't align with the standard terms or criteria of many of the high street banks. These lenders offer more flexibility. Quite often, it just means that there's going to be a manual underwriting process. So, you're going to have someone look at the application and be able to make an assessment based on that. We're all human beings. Things happen. Sometimes payments are missed. Sometimes we have health issues that mean maybe we miss a mortgage payment or whatever. Specialist lenders are there to help. Now, the idea should be if your mortgage broker places you with a specialist lender for a period of time, when you go to remortgage, whatever the issues are that caused you to go to the specialist lenders, hopefully those things will be resolved. And as I said, it's all about choice. So the next time around, you will be able to have more choice. Let's talk through the mortgage process because this is something that not everybody understands. And if you've had a great mortgage broker that you've worked with in the past, a lot of what I'm explaining, you probably don't know because they did all the work for you. I'm here today not to replace that conversation with your mortgage broker or to give financial or legal advice, but just to talk you through the process that you can understand some of the terms better, that when you do speak to a professional, you know what questions to ask. So, first thing is an affordability assessment, then an agreement in principle, valuation and underwriting, mortgage offer. The solicitors then get involved, exchange and completion. But I'm going to talk you through each stage. So, the first thing you want to do before you do anything is get your credit report. Go and get a copy of your credit report, understand what's on there. You'll then approach a mortgage broker, hopefully someone that's been referred to you by someone you know and trust, and a mortgage broker that they've used recently. That mortgage broker is going to do an affordability assessment. This is very different than going on Rightmove or Zoopla and plugging in numbers, or going to your bank and plugging in numbers. A broker is going to also take into consideration criteria. So they're going to say, well, you're currently on probation, or they're going to look at the different things. They're going to be able to assess generally, based on what you've told them, how much you can afford to borrow. That's the starting point. Make sure you're open and honest with the broker. That way they can give you the best information. Once they've done that assessment, they'll be able to produce what's called an agreement in principle. Some people call it a decision in principle or a mortgage in principle. Keep in mind, a AIP, or an agreement in principle, is a great start, but it's not the end of the game. In most cases, an agreement in principle is not a full credit search. It might be what they call a soft footprint. They're not validating what you've told them. It's just the bank saying, in theory, based on this cursory information, we would be willing to lend John Doe this amount of money. It's not a binding contract. And as I said, the full underwriting has not been done. So you should certainly get an agreement in principle, because in most cases it will be required by the estate agent in order for the estate agent to allow you to make an offer on a property. So you get your agreement in principle. It's going to give you a good guide on how much you can borrow. Rule of thumb, bit of advice: if your agreement in principle says you can borrow 500,000, don't tell the mortgage broker 500,000. You want to tell them a little bit less. And I'll tell you why. No one ever buys at the bottom of their budget. So more likely than not, you're going to tell the estate agent, when they ask you what's your budget, you're going to tell them, oh, it's from, 475 to 500. They're going to show you houses at the top of your budget. It's pointless them showing you houses at 475. So they're going to show you houses at 500 and more. So that means you've been approved for 500,000. They're showing you houses at 520. Even with negotiating, you might end up above your budget. So what I would recommend, understand that if your broker offers a negotiation service, take them up on it. But if you have an agreement in principle for 500,000, you want to make sure that you're looking at houses, or let the estate agent show you houses at about 480, 490, but not above 500,000. That's not to say you can't negotiate down. So you now have your agreement in principle. You've now found your house. That offer's been accepted. Once the offer is accepted, that's when you're going to do the full mortgage application. So this is when you're going to convert the agreement in principle into a full mortgage application. Why is this important? It's important because the agreement in principle is based on lending to you. The full mortgage application takes into account the property that you're looking to purchase. So the lender may want to lend to you, but they may see an issue with that particular property. So they're going to do what's called a valuation. The valuation is a valuation and not a survey. The valuation is for the lender. It's not a survey. The valuation is for the lender to assess what they think the value of the property is. The survey is something completely different. There's three outcomes that you can get when they do the valuation. So there's three outcomes from the valuation. It can come in at what the offer was. So you got an offer accepted for 500,000. It can come in at the 500,000. That's great. The lender could say that they think the property is worth more than the 500,000. The thing that you want to be concerned about is if the lender says that they think it's worth less than the 500,000. That will impact the structure of the agreement in principle that you have. So the valuation will be done. They'll do the underwriting. The lender will request certain documents from you: 3 months pay slips, 3 months bank statement, ID, etc. Some lenders use what's called open banking. So you'll essentially be sending them the information that they can access your bank account. It's only for the purpose of the mortgage. So they'll do all the underwriting. This can take 7, 10, 15 business days. So be prepared for that. Once the underwriting is done, this is what you've always wanted. You're getting your mortgage offer. So the mortgage offer is saying, yes, we will lend to you on this property. Here are the terms. These are what the monthly payments are. The mortgage offer is usually valid for about 6 months, but it will have a date on it. If it expires, or if it's about to expire, your mortgage broker can usually see if they can get it extended. But you get your mortgage offer. Once you have your mortgage offer, the solicitors kick in. As you know, I always say, don't pick your solicitor based on price. Find a solicitor that's responsive, will answer your questions, and is providing a good service. Buying a home, the mortgage process, I should say, is as fast as the slowest person. So if your broker is slow, it will take a long time. If your solicitor is slow, it will take a long time. If their solicitor is slow, it will take a long time. You can't control the other party's speed, but you can make sure that you're working with a broker that is quick, responsive, always keeps you prepared and informed about the next steps. And you can select a solicitor, again, that is quick, responsive, is going to always keep you informed of the process. So once you have the mortgage offer, the solicitors will do their bit back and forth, talking about different things. You'll pay your fees. Then you agree an exchange date. Then you will agree a completion date. Remember, you don't go to a mortgage broker to get a mortgage. You go to a mortgage broker to get a home. So you want to make sure that your mortgage broker is able to get you from that initial conversation all the way to getting your keys. The way that our process works at our firm, we make sure from the onset, when we have the initial conversation around affordability, that we validate the information that you give us. So we will ask you for the documents in advance. That way, we can ensure that the agreement in principle that we get you can convert into a mortgage, because it's pointless if you have an agreement in principle that does not convert into a mortgage. So your next question might be, how do I prepare? How do I prepare to get a mortgage? How do I prepare to speak to a mortgage broker? It's quite straightforward. Review your employment contract, tidy up your bank statements, check your credit report, resolve any issues on there, any unsatisfied CCJs or defaults, maximize your deposit, and speak to a mortgage broker. I would recommend, and I always do, that you speak to a mortgage broker at least 6 months before you think you're ready to buy. Why is that? Your mortgage broker will be able to advise you on how to make sure that when you do apply, everything is in order, that your deal can go through quickly. Most mortgage brokers, like myself, will be glad to have that conversation with you. That way, when you do come back, you're prepared, your bank statements are tidy, any credit issues have been resolved, and then they can start the process with confidence that they'll be able to find you the very best deal without any delays. Don't forget, looking for a house is a full-time job. So don't think that you're going to get your agreement in principle, spend one weekend and find the property you love, make an offer, it's accepted, and in 2 weeks the mortgage process starts. It doesn't usually work that way. So prepare yourself, understand that the process takes about 4 to 6 months from the moment you get the offer accepted. So prepare yourself, understand every step of the way, make sure you ask questions. And as I said, I'm not here to give legal advice, financial advice, or tax advice. And I'm not here to replace having a conversation with a mortgage broker that you know and trust. But if you don't know a mortgage broker, you can reach out to me. I can do what's called a free mortgage capacity report, where I'll be able to tell you how much you can borrow. If it's short of where you want to be, I'll be able to explain to you some things that you can do, or maybe some alternative methods of getting on the property ladder. But don't give up. Ask questions. Educate yourself. If you've watched even 2 minutes of this video, make sure that you subscribe. This is a tiny channel. I try to make content that will inform you and educate you and give you the right tools to make an informed decision. As always, if you don't keep up the payments on your mortgage, your home could be repossessed. So make sure that you're buying a home within your budget, that is affordable, you have the right protections in place, and that you ask questions. Be sure to like, subscribe, share this video with anyone who may benefit from the information. And don't forget, if you have nieces, nephews, or young people, these videos are designed to give them the tools to get on the property ladder sooner, that they can start to build generational wealth, not only for them, but for your family. My name is Anthony Lindsay. I've been in finance for over 30 years. And thanks for watching. And don't forget to like and subscribe.